Alright, what's going on guys? Edward here, back with another video. Thank you so much for being here again in this part 3. By the way, if it's the first time you're actually watching this video, I recommend you going here on top. I have placed actually the previous 2 videos that you need to watch, okay, before this. Actually, I included also a playlist in there, so I recommend you go ahead and watch them, okay? This is all based on market structure and smart money concept, okay? This time we're going to be talking about liquidity and inducement, all right? These are kind of similar things, although they have a different way of seeing it, or they happen in a different way. I'll explain that in a minute. But they all end up being actually the same thing, which is money, okay? Just as an example, just quick right here. Let's suppose we have an uptrend just like this. Very quick and simple uptrend, right? Now, easy to understand. Below these lows, there's always money sitting. Even above this high, there's always money sitting above these highs, okay? Why? Stop losses, okay? There are plenty potential retail traders every time the price is pulling back, I don't know, based on whatever they see here, maybe a support in the past or resistance or something, or even Fibonacci rules, 50% of the Fibonacci, 61.8, whatever they see here, they're most likely actually going into buys, and they place their stop loss below the low and take profit, let's say there or higher, I don't care, right? The thing is that whenever the price is pulling back below any previous low or above a previous high, there's always money sitting. The same right here from potential sellers, right? Sellers saw something, maybe a support, a trigger, I don't know. Maybe they're just waiting for the pullback, or they're using RSI, they're seeing divergence, the price, they think the price will drop or will crash, right? So they go for sales, right? So it means that above those highs, most likely there's money sitting, okay? You don't need to be smart to understand that. You really don't need to be a scientific to understand that. Everybody knows that. The banks know that. The market makers know that. And this all this algorithm that moves the markets up and down, it's actually, it works in a way to actually wipe those and take those liquidity out. Take that money that is sitting in there. You know, the algorithm will make the market move in a certain way to, at some point, eventually wipe those highs, take those liquidity, take that zone, okay? Remember that in overall, the markets need liquidity, need money in order to move, okay? It's fuel. Money is fuel for the markets to keep moving, all right? So that's basically it. Liquidity is money sitting somewhere, okay? It could also be in a consolidation. Let's say the market is just consolidating like this. The more the market consolidates, the more money it's being placed above these zones, okay? Lots of money being placed above and below, right? All this is liquidity. Above that zone, you have no idea. The more it consolidates, it means there are, you know, hundreds of thousands, millions of dollars above. So eventually, at some point, the markets will try to wipe, you know, maybe induce people and then maybe go to a certain direction. But they will take all the liquidity that has been accumulated, all the stop losses that are below. They will eventually wipe them out. Also wipe the ones at the top, right? Boom, to then perhaps continue pushing up. Or who knows the direction where it's going to take. But understand that whenever it consolidates, sometimes even on a trend line, right, there is liquidity. Everything is money. Below the lows, consolidation pretty much is money. Now, inducement is the same thing as money, but is, for example, inducement, the way I see it is like in here, in this scenario, right here, when the market drops, right, take that liquidity, and instead of actually continue crashing, right, something like that, what the market is going to do is just now come back very strong to the upside, and will maybe do something like this and then push, okay? So what the market is doing here is, first, it's inducing people to go selling, right? Why? Because if you see, this is a resistance, this is a support, I'm sorry, right? This is a resistance. So Retail traders, whenever they see a break, they will most likely follow and go with it. Either aggressive sellers, right? They will try to get in, potentially somewhere there, and they will place the stop loss somewhere above the zone, right? Something like that. So this little break right there, that little wipeout of this liquidity, that little break, it's inducing, right? The word inducement, it means that it's making buyers or sellers jump in. It's forcing people to jump in into a certain direction. Okay, in this case, bearish, right? They're thinking that because it broke that consolidation, the market will go down. When in reality, it's not ready to go down. Maybe it's touching some sort of order block here in the past. Whatever it's happening, you know, maybe the market will be mitigating something, and it's a little trap, a little manipulation. And if you also see here, when the market pushed up, also wiping these highs out, this is also inducing buyers to get in, right? Which most likely they are getting into that zone, maybe placing the stop losses below this low, right? Just in case, just to prevent, right? What market is going to do now is come back down, swipe, right? It's going to induce now sellers or taking liquidity there, right? I call that also inducement. So a little trap manipulation, and now the market is actually going to go up. So it's cleaning a lot, it's taking a lot of money from everywhere. It's taking money from here, from this stop losses. It's taking money. It's inducing sellers to jump in when in reality the market will go up. So at the end of the day, boom, they got stopped out because the market goes up. These buyers right here, they enter right there when the market decides to now go down and stop them out. There's more money being taken right here, and now let's get it, right? So the price will now start pushing up. So this is basically what it means. This is what is called inducement, right? It's a little manipulation. It's a little trap. So for that, let me go ahead now and jump on the chart and give you a couple of examples. All right, right here in this example, we can see that the market was actually going to the downside. Yep, definitely was pushing up, pulling back. Little correction right here. Even I think there was an order block right here also got mitigated. Maybe on a 1 minute time frame, lower time frame. We got a break. So market is definitely going to the downside, right? But let's see what we can mark up here. So I'm seeing definitely this low was broken, right? The market created this low, then pushed up, inducing right here to the upside. So this makes this break actually right here. It is my confirmed boss, right? I do have a break of a structure right there. Once the market breaks, pay attention to this. The market creates two potential zones. Actually three, to be honest. We got this one right here, this POI. We got this one. And we got the origin, like the very top, right there, okay? How do we know which one is going to get mitigated? We don't know. What I like to wait at least is for liquidity, okay? I want to see liquidity, which the market has started to consolidate in this area, started to consolidate above this zone. So guess what? We have liquidity right there. We have just money sitting above those highs, even above all this zone, above this highs also we do have liquidity. Hold on. Above this little consolidation right there, we also have liquidity. And the market will eventually take it down, mitigating the second order block right here, which I'm going to be specifying on the next video, but which, by the way, I do have also a couple more videos talking about this, but at the moment, like, I just want to discuss about liquidity. So I'm just going to show you right quick what it is. But we did have this POI. This POI got pretty much burst through. The market actually went up, stopping these highs out. The market was taking liquidity, right? Then mitigating the zone, potentially maybe getting an entry here on lower time frame, then go sell. All right. Actually, this one got mitigated. The one at the top was also attractive, to be honest, and it would have definitely play out as well because you do have imbalance. Remember, whenever you are trading order blocks, you want to see all your confluences. You want to find imbalance, liquidity, maybe using your Fibonacci as well, knowing if you are in a discount or premium zone. All right, all of that is very important. What do we see since after the market mitigated the zone? We had a very strong break right here, with the body of the candle actually closing below. That's my confirmed boss, right? We do have another break of the structure. Now pay attention again here. After the break, price makes a little correction and drops again, creates another little break right there. We're going to mark the zones, right? We do have this one right here. This is a POI, right? Another zone that we have is this one at the top, okay? Two zones. Guess what? The ones that at the bottom are normally not that attractive is because of liquidity. Remember, market needs to take liquidity, guys. So normally the POIs, the first zones that, or order blocks that you see, or POIs that you see, the first one that you see at the bottom, they are normally being wiped out. Why? Because it needs liquidity. The market needs liquidity. Okay, it needs to take liquidity. So if you see this, the market went up actually to mitigate the one at the top. This one, it's already mitigated. To be honest, this one was touched a couple of times. It did struggle a lot to fail and then continue breaking to the downside. It did end up breaking, but it did struggle a lot. However, it did play out very well on the top right here on this supply zone, right? But as I mentioned, market needed to take liquidity. So this POI was wiped out. Look at the consolidation, right? When the market was consolidating right here above this highs, this is all liquidity right there, okay? Sitting. That's money sitting above those highs. Even above this high as well, stop losses were placed above, right? Market will sweep them out before actually going to the downside and then now confirming the next break of the structure. So that's basically it. Let's go for another example. Now in here, it actually you're gonna see it's actually something very interesting that was happening. If you're a retail trader, you spotted this potential support right there and resistance, right? And the price climbs back up, even retested here. And there's most likely a ton of buyers, retail traders actually looking to buy here, and they're placing their stop loss below the zone. Maybe the take profit is going to be above that high or so. You know, every time, most likely a ton of positions were open right there. Even right here with this bullish engulfing candle, I'm sure a lot of positions were open there, and the stop loss was below the zone. So what do you think is actually going to happen? And this is where the inducement happened, the little manipulation, okay? And if you're not a smart money trader, that you're actually seeing what is happening, you're most likely going to get stopped out. If you were a smart money trader, then you're going to be seeing that there was a little order block right here. That's where the market was aiming to, right? Mitigating the zone before actually pushing up. But you see this whole thing that happened here, this is an inducement, right? Because one, the price is, of course, stopping people out before going up. The actual direction was to the upside. So this little support and resistance here, it was literally nothing. It was literally nothing. Right? It was, the market went down to manipulate, to stop people out, right? To stop especially retail traders out, right? And even inducing sellers now. Okay, this is why it's called inducement, because after the break, there's sellers most likely entering on that candle right there, right? The stop loss is above, and the take profits, maybe they want to aim to that low right there. And what is happening? The market is not even getting lower. The market just literally went down, mitigating this little order block, which was really nice. I do have imbalance. If I start looking for all the confluences, most likely I had all the confluences I was looking for here to then go buying. That's basically what the market did. You see, so this little manipulation or trap right there is called inducement. It's inducing people to go selling when in reality the market will go up. It's a little trap and manipulation basically to take liquidity out. So it's basically the same. You see, they normally go in combination. Inducement, liquidity they're different, but at the end of the day, it's actually the same thing. It's basically liquidity. It's money that the markets are taking. All right. So I hope you guys understand. In this third part, I'm going to continue with this series. If you want to see more about this series, please leave it on the comment below. Give it a big thumbs up to motivate me to keep posting more videos based on this. All right. Again, if you're new, please subscribe, give it a big thumbs up, and I'll see you in the next one. Take it easy, guys.